Okay, we're gonna wait a few minutes for people to join. Thanks for coming, everybody. Get settled in. We'll start in about 3 minutes, less than 3 minutes. Get started here in a couple minutes. Let people join in. One more minute and we'll get started. Thanks everybody for joining and taking some time out of your day. Happy to be here. Been looking forward to this all week. I'll get started in about 30 seconds. Right. Wait for those who come in right at noon. All right, let's get started. Again, thanks everybody for coming. So glad you're here. Happy to be here. And my name's Britton Williams. I'm a financial advisor with Calamita Wealth Management. Todd Calamita, he's behind the scenes today. He's going to be manning the Q&A and the chat. Feel free to put in questions throughout. We'll get to those at the end. This shouldn't be more than 30 minutes, and then I'll leave another 15 minutes for questions at the end if you're still awake. But yeah, this is going to be a high-level overview of what's worked well with our clients over the years. I've been in the industry for about 15 years, 20 years in finance and investments. Todd, longer than that. And we just thought that at least we could share what's been working on a high level, not to get into a lot of details. I'm not going to go over a lot of numbers. I'm not going to mention a lot of rules of thumb and, all that. When it comes to the detail, it's specific to you. We need to meet one-on-one. If you're doing it yourself, that's great. If it's working, hopefully there'll be something you can identify and take away from this today. If you're working with a financial advisor, maybe this is something you can bring to them to help you out. And so running out of money in retirement can be prevented. Financial planning in 4 critical areas of your life. All right, so let's just start out with what you're going to be able to take away from this today. I'm going to be sharing some client stories. I'm going to be going over this. We're probably going to be finishing this in about 30 minutes. If you're just joining us, we're going to be touching on 4 key areas that's worked well to manage our clients' lives on the financial perspective. A better understanding of what those areas are, but how you can also coordinate them. I'm going to cover that. As well as just some mistakes that I've picked up on from clients over the years. There's going to be so many more that I'm not going to be able to get to, but I think that's kind of where we learn our lessons. The next thing is there's one area that I want to emphasize on when I get to it, and that's going to be in a few slides, but that's the most neglected, most important, misunderstood area that if it's not managed properly can implode your whole plan. We'll talk about it broadly today, but really when it comes to you need to be working with somebody else, or at least acknowledging it in some capacity. All right, so these are the topics. So I like to start with where I meet with clients initially. And even before they become a client, I want to know what retirement means to them. So that's retirement visions. It's important for us to know what makes you tick. What do you want to do in retirement? Because all of this financial planning needs to come back to you and that lifestyle. So we're going to talk about that in the next slide. There's 4 financial quadrants. We're going to talk about each individually, and then some ways to allocate your investments and generate income. We'll touch on it high level. We're not going to get into the numbers because that would be specific to you, but at least a starting point. And then lastly, coming back to that overriding question of how to prevent running out of money in retirement. And so a vision for retirement, what does that look like for you? That's specific, different from everybody. I spend a lot of time with couples, and they're going to have different answers. And, an example would be, I was meeting with this one couple, and husband and wife in this situation. And at the moment, she had been retired and he had not. He had been working for 30 years, and the kids are already out of the nest, and all of those expenses are paid for in the college perspective. And I call them Sally and Jim for now. So I asked Sally, like, when do you want Jim to retire? And she said, I don't want him to retire. And then Jim goes, I'm done. Like, he wanted to just finish in retirement. And so I needed to dig deeper on that, because they're not on the same page. Jim wants to retire. Sally doesn't want him to retire. And come to find out, she just didn't want him around the house all the time, because what is he going to do? He's been working for so many years, and he goes to an office 9 to 5. It's changed a little bit with COVID, but still, it's like, and she's not wrong, but at the same time, that needs to be aired out. He's like, I got a kayak. I've got a woodshed of wood. I've been wanting to, I used to do woodworking, Sally. Like, so I've got these hobbies I want to get back to. So there's some communication that needs to happen around this vision for retirement. Again, there's also a question that I ask a lot of people if they have trouble identifying this, like, what 3 things make up your ideal day? And so maybe write those 3 things down. An example would be a client that I've been working with for many, many years, and she finally retired. She had plenty of money to retire on. She's got a pension and a Social Security, so that was unique, and she's living off of that. But she just won't spend money outside of that. And so the 3 things that she wanted to do was, the first thing was to see the sunrise, take her dog on a long walk, and then be of service to somebody else at the end of the day. I think that's beautiful, but it still doesn't help me get you to spend more money. But I think that the point is that it doesn't have to be about money to find purpose in retirement. And so these are just some questions that come up along the way that I help people kind of to build in what may be called financial goals in our industry, but ultimately it comes back to what you want to do with your time. And so financial quadrants, this is when we get into, when it comes to comprehensive financial planning, which we do, we get into a lot of details. There's a lot of behind the scenes that we are doing with what we have control over, and who are we communicating with. There may be accountants involved, attorneys, lenders, bankers, insurance agents. If we're not on the same page and working in a vacuum, then the client's not going to be we're not being of service to them. So if you're doing it yourself, that's great. If it's working, I'm not here to convince you otherwise. But maybe you can pick up on some areas that you may can focus on, that you may be neglecting. So the first one is cash flow management. And the second one is investment positioning. Third one is tax planning. The fourth one is estate preservation. Any decision that impacts you financially fits somewhere in one of these 4. So at Calamita Wealth, we do financial planning for all clients. We integrate and coordinate all forms of planning, not just the investments. if you speak with 3 to 5 different advisors, they may do different services. So you want to find the right one for you. This is what we found that works, is to bring this simple concept to our clients and ask them one question. Every time I meet with them, even before they become a client, I ask them, what is it that's most concerning to you in these 4? Like, which one is the most concerning today? And then I'll expand on that. So today, a lot of the times people are saying investments because of the bear market, but I've gotten every one of them. It depends. And I want to know why. Because if they're concerned about the investments, I kind of also want to know how much news they're watching and, where are they getting their information from? Because there's a lot of misunderstood concepts out there given out by people who are selling ads. So, and the internet, of course, can play a role in that as well. So, but I want to keep it, I want to know where they're coming from, but also go over like really how well they're doing, what track they're on. And so I'm going to break down each one of these in the next few slides. But the goal of this is to identify some gaps in your plan, in your financial lives. What can you do to improve those gaps? So first, you got to find out what they are. And so what I've been found that works is doing this initially before, when I meet with people before they even become a client, and then also throughout, assessing them in detail, each one of these. And so cash flow management, I may, clients, I'll ask them, what are they spending on a monthly basis? And I want to know, are they saving as much as they can towards retirement, and then putting enough away for travel, and all the buckets are filled. But really, their standard of life, their quality of life, their standard of living is based on like, what are they spending generally on that monthly basis? And that's going to be a key variable and assumption that I can use for planning. A lot of times people don't know that. I'll talk about that in a minute. So let's just start with cash flow management. What it is, it's essentially the money you need now and later, your inflows and outflows, the money coming in. I work with a lot of Wells Fargo employees. Over the years, we've just found ourselves into this kind of niche in the area. We've gotten to know what you have available to you on all of your benefits, and so we just want to share this with you all. And when it comes to the cash flow management, you have, most of you are on W-2, and you've got that steady paycheck coming in. You've got deductions coming out and going into their 401k. Maybe you're old enough to do the catch up over 50. You've got a bonus coming in at the beginning of the year around February or so. That's a big decision of what to do with that all of a sudden lump sum of money. And because that's outside of what you've been living off of. And so you have options at that point. And so we want to talk through that with clients, because there's a balance between, renovating the bathroom and investing it, and, going on trips and buying a car. So it's talking through and making sure that it's not going to gyrate your lifestyle too much, because it only comes once a year. And then you have the restricted shares that come in, and that's not really in the cash flow piece, more in the investments. We'll talk about that in a minute. It has its own risks. And so these are just some questions. I'm not going to go through all of them, but there's so many more I cut out that I typically bring up. But how do I go from a steady paycheck to living off of my investments? I have a physician client who brought this up to me. And among other questions, this is one of the ones that stood out because it seems so simple. You've been working for 20 or 30 years. I call him Jim. And Jim's been a surgeon and, top of his field. He's got his nest egg built up. He also has a pension and, of course, the Social Security, and he's got the house pretty much paid for. But he just doesn't know how the mechanics work. Like, I go from this paycheck every month. Like, I've got the 401k, the pre-tax money. I've got the Roth portion. I've got the taxable portion. What and when does that all turn into income in retirement? So a coordinated plan to generate income in retirement is what he's referring to. And so he's a new client, so we're currently building out the plan right now. I know how that's going to work, but as what we try to do is make sure that is the transition into retirement is as seamless as possible. So if you're doing it yourself, you need to be aware of where that money is going to be coming from investments, because there's tax implications. You need to make sure that your estate plan is including all those accounts. And so that coordination is going to be a theme in those 4 quadrants. So investment positioning. These are your investments, whether it's the liquid investments, which makes up the bulk of most people's nest egg with the 401k, or your real estate. Maybe you've got some rental income. Maybe you've got inheritance coming in the future, or it has already happened. And so building your net worth with investments, it makes up a large portion of that. But how should that be invested now and into retirement? It's the most common mistake I see. I was meeting with a Wells Fargo. He wanted to retire in the next, well, he's already retired, but when we were meeting, it was back within the year. And it was back last fall. And he had built up probably $2 million in his 401k and restricted shares. And he had some other taxable money. He'd been around long enough to get the pension that had been prior to the merger. And he had, in the ESOP portion of your 401k, you get the Wells Fargo stock. And that made up a huge portion of his account. He was already in 100% equities. And then in addition to that, he had the restricted shares, high 6 figures. And so there's a huge risk there, because this is fall of 2021. This is before the market dropped. And so immediately I said, we gotta do this. We gotta address risk. And so we got him to sell the ESOP portion, rebalance it into a more conservative or a more in line fund allocation based on his risk capacity. And we'll talk about that in a second. But he wanted to hold on to those restricted shares, right? Because there's a tax implication. Even though I went through the cost basis and he wasn't going to have to pay a lot of taxes, he wanted to wait for $60 a share. And of course, everybody was waiting for that high watermark. When is Wells Fargo going to hit $60? He missed it. So it dropped. Then he we'll wait for 55. And so here's the theme. He's emotionally wrapped up in this decision, and that's where we come in. I'm not emotionally wrapped up in it. Your financial advisor shouldn't either. And so you need to be aware of those emotions. But really, it's not emotions, it's risk. And that's what I want to talk about. That's the most important, neglected over. Even when we have to do it in this industry, I don't see it done the right way. And so that's what can really implode your plan. And there's 2 types of risk. And we've heard a lot about the risk tolerance. It's very common. Most of you have been exposed to some sort of questionnaire you signed or filled out over the years. And it gives you a number, a quantifiable score. Maybe an advisor did it. Maybe you did it when you signed up for a 401k. And it needs to be done. We need to know what your tolerance is to risk. What are you comfortable with? But it's hypothetical. It's not until the market drops 20 or 30+% and your accounts are 100% equities do you really feel it. And so we do need to acknowledge that. But what should override that is risk capacity. So how much risk do you need to take? And that is more difficult to determine. And so in other words, just because you're 55 years old, should you take as little risk as possible? You may need to be a little more aggressive. But what's going to determine that is financial planning, and and the purpose of the money, if it's to fund spending, travel, taxes into retirement, in the next 20 or 30 years, the next chapter of your life, then we need to both build the plan out. And what I've seen work that you have to do is also maintain that and update those assumptions. And so what I do is solve for what's the least amount of risk that we can take to be successful. And And so building this plan is not done, it's not said lightly, because we have to make sure we have all the assumptions correct and those are updated. But ultimately, addressing those two types of risk is really the takeaway I want you all to hear, have from this section. And in order to do that, if you're doing it yourself, at least you now know, if you didn't already know, that you need to make sure you acknowledge that, because there are ways to determine, what's the capacity of risk you need to take. So I'm going to move on. So we're running out a little low on time. So tax planning is next. I'm not a CPA. I don't like to do my own taxes. I pay somebody to do it. Again, when it comes to handing things off that you don't want to do, it's probably a good thing. But if you're doing it yourself, I got plenty of clients to do it. It's not bad. That's great. You've gotten efficient about it. That's wonderful. But instead of just putting that tax return in the drawer, there are some proactive measures that can be taken to make sure that what you earn, you also get to keep. So it's one of the examples that I'll give you is a client who was retiring, and he had dropped from a 35% tax bracket to like a 12. I mean, and it was beautiful. But there were a lot of opportunities there. We had all of his money that was saved up in pre-tax 401k. So we converted some of that to a Roth after we did a summary to analyze what the tax implications would be. And so that's one of the opportunities, is to convert it when you're in a lower tax bracket, your pre-tax 401k to a Roth IRA. And that does two things. You start to bank tax-free earnings over the next few years in the retirement. You have tax-free income. So there's three things actually. So that tax-free income is the second thing. The third thing that the Roth IRA conversion is going to do is also lower the RMD, and that's the required minimum distribution you have to take out at 72. Again, it's something you want to not just do on your own without some professional guidance. And it's typical that I've seen the CPAs, a lot of them don't have a lot of time to do tax planning, but they do carve it out. And a lot of times this time of the year. And I've worked with some really great ones. All right, lastly, estate preservation. Okay, this is probably the one quadrant that is neglected altogether most. And that's because it doesn't impact you while you're alive. It's taking measures to protect everything that you own. I mean, all your assets and capital, you've got your income, you have your investments, you have your house, your car, all that needs to be protected. And there's a lot of subcomponents to this. There's risk management. There is, and that makes up all the insurance that you need. And so you have life insurance, disability, property and casualty, long-term care. It's a big one. But everybody can walk away and make sure they have two things set up on their 401k, and that's your beneficiaries, your primary and your contingent. It's common to forget about that backup. Put the kids on there. But ultimately, like a will and a power of attorney document should be prepared. And where we come in, this is an area that I've got 3 calls next week with estate attorneys and clients, because there's that collaboration, the meeting of the minds outside of what we do professionally alone. I'm not going to prepare those documents, but I'm going to make sure the accounts are titled correctly. If they aren't, then it's pointless to create a will and a trust rather. And so this is an area of risk that we proactively are watching, because a lot of times people haven't done this piece, especially the will, and we have an expanded team to help them. So if you're doing it yourself, you're probably going to be leaning on these professionals anyways, but you may want to get some objective advice as well to make sure it's the right amount. We don't make any commissions on insurance. We're fee-only independent advisors, and that structure we feel it insulates us as fiduciaries for our clients. So it's very common that we do our own objective analysis for the right amount of insurance, whether it's long-term care or life insurance. And then we have resources to make sure that's executed. In other words, some firms that we work with. All right, so real quick, how to allocate your investments. You've got, because we're running out of time, I'm going to speed it up a little bit. We've all seen the pie chart, and you have it split up between different positions, whether it's equity, bonds, international, REITs, 25% each. This is a little different concept. To generate income in retirement, you can't have it all invested in equities because you're going to be having exposed to a lot of volatility. And so what has worked with us over the years with our clients is to separate it out into the income portfolio and the growth portfolio. And there'll be multiple accounts in each, but we like to use like 7 years of income in income portfolio, and it's going to be growing, but just not as much. And that's the purpose of that portfolio, is to be drawn down while the growth portfolio continues to grow, is exposed to the volatility, but that's how we keep up with inflation and the other needs into the future. Again, we can go, I'm not going to go through the numbers on this because I would have to go through the risk for each of you individually, but it's a great one-on-one call with your advisor. All right, and to wrap it all up, how do I prevent running out of money in retirement? So this question, the answer is in financial planning. I haven't been able to see ways to do it without it. There's not a silver bullet. I've been in the industry long enough, like I've focused solely on investments at one point in my career and how to avoid large long-term losses. And ultimately, there's just a need to collaborate with all the professionals in these different quadrants. And nobody has a crystal ball. So there's definitely a need for us to make adjustments and manage the investments, which is what we do very well. But how they're managed, I've got to know what's going on in the other areas. And whoever's doing it should know that as well. And so the takeaway is to ask yourself, who's communicating with the attorney? Who's communicating with the accountant? Who's doing the tax planning to making sure that you are saving as much in taxes? But also, are you doing things in the investment area that you're also communicating to your accountant? For example, making non-deductible contributions to your IRA. The accountant's not going to know about that. And if you don't tell them, it's not going to be filed properly. Between that and Roth conversions, they don't, I've made corrections, I've pointed out corrections or mistakes rather on clients' tax returns that they need to go back and get amended. So it's important to be aware of these. All right, so that brings me to the end. I'll open it up for questions in the chat, and Todd is also going to be fielding some of those questions. We got a few more minutes. Feel free to type them in if you do have any. I also have on this screen my email. You can email or text, call me. And then if you'd like to set up a call with us, the best way to do it is go to our website. There'll be a link in the chat that Todd will put in there. And on the site, there's a link to set up directly in our calendar. I'll give it a couple more minutes. Okay. All right, we got some questions coming in. All right, so could you, Charlie has a question. Could you reiterate how your firm specializes in managing Wells Fargo employees' assets versus non-Wells? Yeah, absolutely. So I did mention that a lot of our clients do work at Wells Fargo. It's definitely not exclusive to Wells Fargo. The way that we manage the assets for those clients, and I think that's what you're asking about when you say assets, let's say the 401k and other specific benefits. We have the ability to have transparency, in other words, real-time access to that. You provide us a secure access with into our planning software. So there's updates on the balances and the allocation. We can see those on the daily. And that's a really good point, because it's not exclusive to Wells. Any 401k, whether it's Duke or B of A or what have you, that we're going to want to know what's in the 401k, and that allocation needs to be in sync with the rest of the portfolio. And so the way we change that or update that allocation is through a meeting with our clients. And because a 401k doesn't have the ability to really, I mean, it's all mutual funds, so they're all traded once a day, and there's some just, it's not as seamless as if we were managing it. We clear through Charles Schwab and having access to the ETFs and other funds and stocks. So we work with what you have available to you, but we can get the allocation in line with and addressing the risk capacity and the risk tolerance. All right, so Vanessa has a question. And again, Charlie, if you want to talk further, let me know offline on that, or if anybody else does. Vanessa has a question: how early should anyone start planning for retirement? Nothing like the present. So you can't go back in time. The question may also allude to, like, where you are like tracking for retirement. So just because you're a certain age, that doesn't mean you need to save a certain amount. And so it goes back to identifying how much you need to save in order to reach retirement and fund retirement. And so the sooner the better. I've worked with clients who are in their 20s and 30s, and they've had access to employer-sponsored plans, and it's hard to convince them to start maxing out those plans early. They can't really max it out sometimes when you first start, but tracking to continue to increase saving towards retirement. So planning for retirement, I want to make sure that that word planning is identified. So there's some ambiguity there, but as far as like what we talked about today, I think it's a healthy exercise. I'm not planning to retire anytime soon, and I've gone through some of those same retirement questions with my wife. All right, so Paul, how does your fee schedule work? Great question. Don't like to ignore this. So we're very transparent. We're a fee-only independent advisory firm. Fee means that's how we get paid. We have a fee structure on the assets under management at Charles Schwab only. So that's important. So if we have $500,000 at Schwab and another $1 million at a 401k, we're not going to be billing that money at the 401k. And the average is around 1% per year. And that's taken out every quarter. So it'd be 0.25 in advance. And that's all of our clients can receive. It's on the statements from Schwab, and you see it as an invoice. You don't pay us anything else outside of that. And again, that question may be specific to you, Paul, so feel free to send me a text or schedule a call. We also do some, and that includes the financial planning that we do for our clients. So I want to make sure that's very clear. A lot of firms, fee only, will charge for planning. If the relationship cannot support the assets under management, in other words, we do have a certain minimum that we work with, then we are open to doing financial plans for a fee. And we're constantly trying to improve that area, and some exciting things are coming in the new year. So thoughts on level of safe withdrawal rate for a typical retiree asset allocation, anonymous. So 50 to 60% equities. Again, I'm going to repeat that question. Thoughts on a safe level of withdrawal rate for a typical retiree with the asset allocation of about 50 to 60% equities. Very specific question. I love it. I want to answer it. It's very common to run across rules of thumb with this question, like the 4% rate, for example. The reason why taking 4% of your assets out in retirement may not work is because of inflation. When inflation's 2%, it works better, but it's not today. And we don't know where it's going to be tomorrow. And so I don't want to jump around it, but I think that what I've found that works is that, and what I've seen is the withdrawal rate early in retirement is very small, like 2%, 1 to 3% usually. And it's because we need to leave a buffer in the end. So when I do my projections in the plan, there's going to be money left over when you pass away. But that's if we're 20 or 30 years away from that, there's a lot that's going to happen between now and then. And long-term care costs come in. And so life shows up. And so we need to be conservative on the front end. Now, the average distribution may be much higher. Like a larger percentage definitely comes out the top of that bell curve. So again, those are my thoughts. It's not something I answer arbitrarily. I'm not a big fan of rules of thumb. Next question is, how are your fees structured? And so as I just mentioned, I think this goes back to the fee schedule work, but the fees structured, I'll just dig into it a little deeper. As I mentioned, so the assets that we're managing at Schwab, you're going to be, at the beginning of each quarter, a fee comes out, 0.25%. I'm using that as an average because that's essentially what our schedule is. Most of our clients are in that ballpark. So that comes out and that covers everything. We don't charge by the hour. We don't charge per project. We do a lot of custom projects for clients. For example, I'm working with a physician who left one of his larger employers and started his own practice, and he just doesn't understand a lot of the business side of operating a business. And so we're meeting every month, but we're not increasing his fee. So there's some consulting opportunities that come around that we're not going to charge extra for. Now, if that gets out of hand, we may need to revisit it, but so far it's been very manageable. And so again, the only thing I'll say about the fee structure, I mentioned it in the presentation. When it comes to insurance and other products, annuities, we don't sell annuities. If you have annuities, we include them in your plan, but we're not going to make commissions on that. And the reason is I'm human. Like I will run the question by me. Like when I give you advice, like I don't want it to pop in my head, like how much I'm going to make on that piece of advice. And so that conflict can be removed. And that's just our choice to have that. But we definitely want to address the risk that product is going to be used to manage, whether it's life insurance or what have you. And so we vet who we work with in that arena. And but we don't make any money on that. And we follow through. And for example, life insurance comes up all the time. We land on a lot of term policies, and I will follow through like the process of getting that life insurance policy originated, and then several weeks later it finally gets enforced. I'm in contact with who's doing that, with that agent and the client. All right, so that looks like it's the last question. It is 12:36. So if you have any other questions, feel free to put it in the chat, Q&A, or I'll stick around for a couple more minutes to see if anything else pops up. Otherwise, thanks so much for joining. This has been a one-sided conversation with the webinar. I'm used to interactions on meetings and, having the ability to ask questions and answer them live. So, this has been really fun, and, look forward to doing this again in the future. Happy holidays. Happy New Year. Chat was disabled. Let me see if I can. Thank you, Paul, for mentioning that to me. Oh, okay. So only the Q&A is open. So feel free to put anything in the Q&A. Hmm. It looks like the other questions. So we got a couple more attendees still there. Okay. All right, I'll close the webinar now.